Why is it that US stocks just keep going up when the rest of the world falls by the wayside? Hello and welcome to today's Daily Blitz. In today's video we'll be having a brief discussion on one force that the US has at its side, which no other country really seems to be able to harness, and that is the topic of US stock buybacks. Stock buybacks are a means by which a company purchases its own shares back from the market, reducing the supply of those shares and bidding up the price somewhat. Instead of simply issuing a dividend to investors, it buys its own shares back, which props up the price somewhat, and it allows the executives who are incentivized based on the stock price and by the performance of their stock to effectively cash in a huge amount on their own stock's performance. There is a lot of controversy over this because originally this was actually classed as a form of market manipulation until I believe it was Bill Clinton rolled back the rules on it. And it's interesting that this is allowed so much in the US, whereas in other parts of the world it is not. And it may be one of the reasons why the US always seems to outperform the rest of the world, because the rest of the world isn't so aggressively buying their own stocks back like the US is.
Yeah, that's especially true over the last few years. As you can see from the chart on your screen, buybacks are responsible for a huge chunk of the US's gains. And to be clear, it's a reduction in the amount of shares on the stock market, which means really it's pretty misleading in terms of you're getting a higher price, but only because you're shrinking supply.
Right, so a lot of people look at the stock market as a barometer of economic performance. And in this respect, I mean, buybacks are kind of a distorting factor. And you often find with some companies in the US, they're actually issuing bonds in order to buy their own stocks back. So they don't even have the money to buy their stocks back. Instead, they borrow in order simply to reduce the supply of their own shares and to compensate their executives and also other investors. And this makes it, as I said, quite a controversial topic, where a company could be not even growing its own operations, couldn't be even getting new customers, making more revenue or profit growth, and instead is just borrowing money in order to buy their own shares back. And one of the main reasons why so many companies are able to issue debt so easily in order to buy their own shares back is, of course, because interest rates are so low. So because there's so much demand for any kind of yield, investors will buy junk bonds, and junk bonds, which are issued purely for the sake of buying back shares, are as good as any other in some people's eyes.
And then there's also the issue of derivatives. So derivatives are based on the price of a stock, and that's not adjusted for how many shares are on offer. So if you can manipulate up the price of stocks by reducing the supply and make money on derivatives because that price is going up, that's effectively market manipulation in an indirect way.
Right. Now, why is it that the US is able to do this and places like Europe isn't?
One of the reasons is the tax legislation. So in the US, capital gains are taxed separately to dividend income. And that incentivizes this behavior in the US especially strongly.
There is an argument that one of the reasons why Europe's stock market has underperformed so much in recent years is because they do not have this mechanism going on in the background where companies are effectively eating their own shares. There's a common metaphor for it is a snake eating its own tail, like the Ouroboros, the classic mythical creature, right?
Yeah, and the risk here is where this goes next, because if these companies have borrowed money to buy back their own stock, but then interest rates go up, that increase in the share price was basically a head fake. It was basically a mistake, a misleading price, and it's going to come crashing back down, and those companies will have to issue new shares in order to raise enough capital to continue their operations.
But conversely, you can look at this the other way around. So if interest rates go negative and companies start being paid by the market just in order to buy their own shares back, this could be an incredibly bullish sign for the stock market as a whole. Even though, of course, this is no longer at all tethered to economic performance, profit growth, revenue growth, etc. So pay attention to buybacks. If you ever see any sort of hints that the rules may be changed regarding buybacks, you should pay close attention. So you find that some of the Democratic nominees for the presidential election are talking about ceasing buybacks and making them illegal once more as a form of market manipulation. If that were to happen, that would remove this huge force behind the US stock market. And conversely, if you see any news about European legislation changing the rules on buybacks to make them much easier, again, that could be quite a bullish environment. But there you have it, folks. Thank you very much for watching today's Daily Blitz, and be sure to tune in next time.